When someone says diversify your income, they mean don't put all your eggs in one basket. Spread your risk, have backup income sources. This sounds rational. But poor people already have multiple income streams. They work 2 jobs, drive for rideshare apps, sell things online. They're incredibly diversified, and they're exhausted and broke. Meanwhile, rich people have 1 job, or sometimes no job, but multiple passive income streams. So why does the same advice produce opposite outcomes? Let me show you what's actually happening. The advice to diversify your income assumes you have income that can be diversified. Not just income that keeps you alive, but surplus income that you can redirect into different channels. And this assumption is where everything breaks down. If you're poor and someone tells you to diversify your income, what does that actually mean? It means get a second job, work nights and weekends, drive for Uber, sell things on eBay, do freelance work, monetize your hobbies, turn every spare moment into earning opportunity. And yes, technically this is income diversification. You now have multiple sources of income instead of 1. But notice what you're actually doing. You're multiplying your labor. You're taking the limited time and energy you have and spreading it across multiple activities. You're diversifying how you sell your time, not creating independence from selling your time. Now let me show you what income diversification looks like for someone who's already wealthy. Rich person owns rental properties that generate income every month. Rich person has dividend-paying stocks that generate income every quarter. Rich person has a business that generates income whether they show up or not. Rich person might have royalties from intellectual property, or interest from loans they've made, or profits from investments in other people's businesses. Notice the critical difference. Their income streams don't require their time. The rental property generates income while they sleep. The stocks pay dividends whether they check their portfolio or not. The business runs with managers and employees. They've diversified their capital, not their labor. So when financial advisors say diversify your income, they're talking to people who have capital to diversify. But poor people hear the same advice and think it means diversify their labor. And these are fundamentally different activities with fundamentally different outcomes. Let me show you why this matters. If you diversify your labor across multiple jobs, what happens to your capacity over time? It depletes. You're working 50, 60, 70 hours a week. You're exhausted. Your health deteriorates. Your relationships suffer. Your mental clarity decreases. You're running yourself into the ground trying to maintain multiple income streams that all require your active participation. And here's the trap. The more depleted you become, the less effective you are at each job. Your performance drops. Your ability to negotiate for raises drops. Your ability to look for better opportunities drops because you have no time or energy to job search. You're locked into multiple forms of exploitation because you can't afford to lose any of them. If you diversify your capital across multiple assets, what happens to your capacity over time? It compounds. The rental income pays down the mortgage, increasing your equity. The stock dividends get reinvested, buying more shares. The business profits get used to open new locations or hire more employees. Your wealth grows while your time remains constant or even decreases because you're building systems that work without you. One strategy depletes, the other compounds. Both are called income diversification, but they're completely opposite economic activities. Now let me show you how this plays out in practice. Poor person works a 40-hour-a-week retail job, barely covers expenses. Someone tells them to diversify their income, so they start driving for Uber on weekends. Now they're working 55 hours a week. Income goes up a little bit, but now they have car maintenance costs, gas, insurance. Their car depreciates faster. They're exhausted. And they're still not saving any money because the extra income barely covers the extra costs. Then their retail job cuts their hours because business is slow. Now they're making less from the main job, so they pick up more Uber shifts. Now they're working 60 hours a week across 2 unstable income sources. Neither job offers benefits, neither job offers security. They have 2 income streams, but both can disappear at any moment. They're more vulnerable, not less, because they're spreading themselves thinner. This is what income diversification looks like when you're selling labor. You're not actually reducing risk. You're increasing fragility because you're dependent on your body's ability to keep working multiple jobs indefinitely. Now let me show you the rich person version. Rich person has a job that pays well. They save and invest. They buy a rental property. Now they have 2 income streams, salary and rent. The rent covers the mortgage, property taxes, and maintenance. It doesn't generate much cash flow, but it's building equity. A few years later, they buy another property using the equity from the first one as leverage. Now they have 3 income streams. One day, their job ends. They get fired or they quit. But they're fine because the rental income covers their expenses. They're not scrambling for another job. They're not panicking. They have time to be selective, to find the right opportunity, or to start a business, or to just take time off. Notice what happened. They diversified their capital, not their labor. And this created actual security. When one income stream disappeared, they weren't destroyed. They had real backup, real stability. This is what financial advisors mean when they say diversify your income. But poor people can't do this because they don't have capital to diversify. They only have labor. So they diversify labor and call it the same thing, but it's not. Let me show you another dimension of this. The type of income. When you work multiple jobs, you're generating earned income. This is income from labor. You trade time and energy for money. Earned income is taxed at the highest rate. And earned income stops when you stop working. When you own assets, you're generating passive income. Rental income, dividend income, capital gains, royalties. This income is taxed at lower rates, and this income continues whether you work or not. So poor people diversify into multiple streams of highly taxed, labor-dependent income. Rich people diversify into multiple streams of low-taxed, asset-based income. The tax code rewards one and punishes the other. The system is designed to make one strategy work and the other strategy fail. And here's what makes this really insidious. Poor people are working harder. They're hustling. They're doing everything right according to the advice they're given. Multiple income streams. Check. Working evenings and weekends. Check. Monetizing every skill. Check. And they're still poor, still exhausted, still one emergency away from catastrophe. Meanwhile, rich people are working less, earning more, and building wealth. Not because they're smarter or more disciplined, but because they're playing a different game with different rules. Now let me show you how the productivity industry exploits this confusion. The entire hustle culture industry sells courses, books, and programs about building multiple income streams. They show you people who quit their jobs and now make six figures from their side hustles. They promise you can do the same. Work on your business in the evenings, build it on the side, diversify your income, create freedom. And some of this advice is legitimate. Some people do successfully build businesses while working full-time jobs. But notice who actually succeeds at this. The person who succeeds has savings to cushion mistakes. They have health insurance through a spouse or family. They have a stable living situation. They don't have dependents relying on every paycheck. They have time and energy because their main job isn't physically demanding. They work a comfortable office job 40 hours a week and then have mental space to work on a business at night. The person who fails is working 2 physical jobs already. They're exhausted. They have no savings. They have kids to take care of. They have no cushion for mistakes. They try to start a side business, but they don't have the time or energy to do it well. They give up because they have to survive today, not build for tomorrow. The advice to diversify your income and build side hustles works for people who already have stability. It fails for people who don't, but the industry markets it as universal advice. Anyone can do this. You just need to want it badly enough. Work harder. Sacrifice more. This is psychological manipulation. It takes a strategy that only works with certain prerequisites and markets it as if prerequisites don't matter. And when people fail, they blame themselves. I didn't work hard enough. I wasn't disciplined enough. I wasn't committed enough. The real problem is they were trying to diversify labor when the advice was designed for people diversifying capital. Let me show you the time trap. If you're poor and you diversify your income by working multiple jobs, how much time do you have to look for better opportunities? None. You're working all the time. When do you network? When do you learn new skills? When do you rest enough to think strategically about your situation? You can't. You're trapped in survival mode. Multiple income streams keep you busy, keep you tired, keep you from having the space to actually change your situation. If you're rich and you diversify your capital across assets, how much time do you have? All of it. Your assets generate income without your time. So you have time to network, to learn, to strategize, to find new opportunities. Your diversification creates time instead of consuming it. One group diversifies into less time. The other group diversifies into more time. Same advice, opposite outcomes. Now let me show you the risk dimension. Poor people are told to diversify income to reduce risk. Don't depend on one employer, have backup income. This makes sense in theory, but in practice, working multiple jobs increases certain types of risk. You're more likely to get injured because you're working more hours, often in physical jobs, without adequate rest. You're more likely to get sick because you're run down. You're more likely to make mistakes because you're exhausted. And if you get injured or sick, you lose all your income streams at once because they all depend on your body functioning. So you've diversified your income, but concentrated your risk onto your physical capacity to work. This is not actually safer. It's more fragile. Rich people diversify capital across uncorrelated assets. Real estate, stocks, businesses, and different industries. If one fails, the others continue. And none of them depend on their physical capacity. So their risk is actually distributed. They've achieved what diversification is supposed to achieve. Let me give you a concrete example of how this plays out. 2 people, both trying to diversify income. Person A works retail, starts driving for Uber, sells crafts on Etsy, 3 income streams. Person B has a job, buys dividend stocks, invests in a rental property, 3 income streams. Person A gets in a car accident, can't drive for Uber anymore, can't work retail because of injuries, can't make crafts because of hand injury. All 3 income streams disappear at once. they're financially destroyed. Person B gets in a car accident, can't work their job temporarily, but the stocks still pay dividends. The rental property still generates rent. They're not financially destroyed. They have time to recover. Their income dropped, but it didn't disappear. Both diversified. But only one actually reduced risk. The difference is labor diversification versus capital diversification. Now, let me show you why the system is stable, why it doesn't change, even though it clearly serves some people and fails others. The advice to diversify your income is good advice. The problem is, it means different things to different people, and the system benefits from this confusion. If you're poor and you hear diversify your income, you think hustle harder, work more jobs. And this benefits employers who get flexible, desperate labor. You're so busy working multiple jobs that you don't organize for better wages. You don't demand benefits. You can't afford to quit. You're easier to exploit. If you're rich and you hear diversify your income, you think buy assets, build systems. And this works because you have capital to deploy. You get richer. Your wealth compounds. And you attribute this to following good advice, to being smart with money, to being disciplined. Both groups think they're following the same advice. Both groups think the advice is fair and universal. But the advice functions completely differently depending on starting position. And this difference is invisible unless you compare them directly. The system stays stable because poor people blame themselves for not succeeding with income diversification. They think they're not hustling hard enough. They need one more side gig. They need to sacrifice more. Meanwhile, rich people succeed with income diversification and think it proves the system is fair. They followed the advice and it worked. Why can't everyone else do the same? Nobody sees that they're playing different games with different rules. Let me show you what this looks like over time. Poor person starts with one job, adds a second job, then a side hustle, then another gig. They're incredibly diversified now, 5 income streams, and they're making more money than they were with one job. But they're also working 80 hours a week. They have no life, no health, no time, and they're still not building wealth because all their income goes to expenses, and they have no energy left to think about anything beyond survival. 10 years later, they're still in the same position, maybe making a bit more because of inflation adjustments, but still trading time for money, still exhausted, still one emergency away from collapse. Their diversification didn't lead to security, it led to intensified exploitation. Rich person starts with one job, buys one rental property, then another, then starts a small business, then invests in stocks, 5 income streams, and they're working less than they were with just the job because they've hired property managers, business managers, financial advisors. 10 years later, they quit the job entirely. Their assets generate enough income to live comfortably. They spend their time on hobbies, family, new ventures. Their diversification led to actual freedom. They escaped the time for money trap. Same advice, same number of income streams, completely different life outcomes. Now you understand why diversify your income is advice for people who already have income, not income that barely covers survival, but surplus income that can be transformed into capital and deployed into assets. If you're trading time for money, diversifying just means trading more time for more money. You're still trapped. You're just trapped in more places at once. If you're deploying capital into assets, diversifying means spreading that capital across different opportunities. You're building systems that free you from the time for money trap entirely. The advice sounds the same, the words are the same, but the economic activity is completely different. And the system profits from this confusion. Poor people work harder thinking they're building security when they're actually just depleting themselves faster. Rich people build actual security and think it's because they followed good advice, not because they had capital to deploy. That's how the same advice produces opposite outcomes, not because of different execution, but because of different starting conditions that determine which game you're actually playing.